Hi, and welcome to Sunshine Startups Live. I'm an entrepreneur, investor, and startup enthusiast, Jim Ryan, live from Emerge Americas. This is our first road show where we're taking the podcast out, and John and I are having a great time. Of course, I'm joined by Dr. John Wemsby. John, it's great to be with you, my friend, here.
I'm so happy to be with you, my friend Jim. This is, we're coming up towards the end of our day. On day one here at Emerge Americas, the energy is still buzzing. You can hear the noise in the background. But this is where innovation, technology, and entrepreneurship is alive. This is a Super Bowl of excitement, and I am so excited about who our next guest is.
Yeah, and he's a friend, and we've known him for quite a long time, a huge supporter, based here in Fort Lauderdale, and a huge supporter of the state in so many ways, and not just helping support and help funding startups, but really giving of himself to work with even not-for-profits, on the board of numerous companies, giving of his time, his mentorship, and his support of so many startups. Mark Volchek from Olas Venture Capital. So Mark, thanks so much, my friend, for being here on the podcast today.
Thanks for having me, and thanks for that very nice intro.
Well, Mark, I want to start off because I mentioned about you giving up so much of your time, and you've been a tremendous ambassador for the fund. We're going to talk about a lot of things, obviously about entrepreneurship and about fundraising and so forth. But Mark, give us a sort of for those of you that don't know, give us a sort of a snapshot of your bio, because you did walk the walk as an entrepreneur, and I think which has made you, in my opinion, an even better venture capitalist. So kind of talk to us a little bit about that sort of transition from entrepreneur to venture capitalist.
Yeah, happy to give you the quick version, the 25 years in 2 minutes. But I started a fintech company in 1999 as a senior in college. And we really were doing first generation conversion of sort of paper to electronic payments for colleges and universities. So that was, the .com bubble burst, I guess, in 2000, right as we started fundraising. But it was a good time to start. There was a lot of talent available. The technology had become more mature. So this was really Internet 1.0. And so that was really my entrepreneurial career. 2 rounds of angel money, 3 rounds of venture capital. Eventually, we raised some private equity money in 2008 and took the company public at the New York Stock Exchange in 2010. In 2014, I decided it was time to do something different, and we decided to take the company private again. And I left my full-time role, stayed on the board until the transaction got completed in 2016. And at that point, I decided, to start a venture fund. What do I want to do next? I wasn't really ready to do another startup. And so I decided to, professionalize my investing. So I'd been doing angel investing since 2008. And in 2016, I said, let's give it a shot and professionalize it and turn it into a real fund. And that was really the genesis of starting Olas Venture Capital with Dean Hatton, who's now my partner in the fund and was one of my partners at the fintech company as well.
So I like what you did, Jim, in terms of laying out the entrepreneurship journey that you went on. And then you got into the real investment world of Olas Venture Capital, which was a very significant imprint in everything that you touch. I'm really curious about what the business does. Can you explain to the audience what Olas Venture Capital is and the types of opportunities that you invest into? And the reason that this is important, we have a lot of entrepreneurs, clearly early stage, early scale-ups, and they think that in some cases money is just money, and an angel's an angel, a VC is a VC, rather than mirroring, or I guess connecting what kind of money for the right opportunity. And I know that you have parameters about what you like to invest into and what has the most chance of success. If you could lay a bit of that out.
Sure, yeah. Every venture capital firm is different and has a thesis and has their focus. So for us at Olas Venture Capital, we're a seed stage investor. So what that means to us is rounds of 3 to 6 million round size. generally at a valuation sub $20 million post. And our initial check is usually half the round, and then we syndicate and find value-add investors to fill up the round. But for that construct, we look for companies that have early traction. And for us, that's revenue generally of, call it a few $100,000 ARR to up to about $1 million. And we focus exclusively on B2B software. Why? Because that's what we know. That's where we come from. And since we're operators, we feel like we add more value into companies that we understand, similar to what we know. But also having a portfolio where the companies are similar to each other allows us efficiencies in terms of connecting our entrepreneurs, learning, what works, what doesn't. There's a lot more pattern recognition the narrower our focus is. But every fund is different. Some are very generalist and some are even narrower than we are. It really just depends. And it's really important for entrepreneurs to research every investor before approaching them, to know what their focus is and what they look for so that they can tailor their approach and also not waste their time if it's not a fit.
I was giving a bit of a formula the other day on a panel, actually this morning, about right plan, right people, right money from the entrepreneur perspective, but it also works from the investor perspective, right? Right plan, right people, right money. And I'm really curious, when you're investing into a company, how much of it is the business versus the people?
I would say in the end, it's a combination of both. When it comes to the business, because we invest fairly early, but there's some traction already, what we mostly care about is the market opportunity big enough? But most things around the business can be sort of fixed as you learn, right? You can expand your market, you can expand your product. There's a lot of things you can do. The team ultimately is the most important, because we generally don't invest to replace the team. Some investors do. We invest in the team, and therefore that's the most important. And when we think about sort of the traction in the business, to me, that's actually a reflection on the team. So if the team's raised, call it $1 million pre-seed, what did they accomplish with that $1 million? How far did they get compared to other people we see who raised $1 million, and how far did they get? It's really a comparative analysis, because there's no absolute things we're looking for, because we look at, on average, about 1,000 opportunities a quarter to make maybe one investment on average. So we have a lot of things to compare against. And so when an entrepreneur pitches us, it might be a great business. It may just not be a fit for us, or it may just be a quarter where we've seen a lot of good things and, stacked against the others, it's not as good as an opportunity. So timing is really important. And that's why I get a lot of questions from entrepreneurs is now a good time to raise? It may be a better market today than it was 6 months ago. However, there's more people raising. So the competitive set today is, I think, much more difficult. I think Q1 of this year is probably one of the most challenging environments for companies to raise money, because the bar has gone up. There's more money being invested, but the bar to get that money has become more difficult.
Makes sense.
So Mark, at this conference here at Emerge, they've already had a numerous amount of speakers talking about AI and quantum. Seems like every company is labeling them the AI of this, and AI is such a broad term. When you're looking at AI companies today, it almost seems daunting from a due diligence perspective. You've got to sort of assess, well, where actually is the AI component? Well, is this true natural AI? Is this something that you put in? Are you white labeling something else? So how do you kind of go through that when you're looking at investing? Because obviously AI is hot. And every company seems to be having that as a moniker.
Yes, clearly today AI has become sort of a tool that every company is using in some way or another. And so we really, right off the bat, try to dig in to understand if the company is sort of a real sort of deep tech AI company. Are they really developing a new LLM or something else? There's very few of those, and generally they require lots and lots of capital, lots and lots of talent, and not something that we as a small fund, or relatively small fund, can invest in. So most of the AI companies we see are actually companies that are using AI technology off the shelf and then customizing it some way or another. Many of them are really just putting a front end on a existing open source AI, and those to us are not that interesting. Those aren't defensible. Those are very difficult to build a long-term high growth business. What we focus on are really, solutions to business problems. So vertical software companies that have identified a problem and are building a solution and using AI as one piece. And AI can be used to make customer service more efficient. AI can be used to make the software work better, to automate certain tasks that before required humans in the loop. And so there's lots of different pieces that AI are used for, similar to the web, right? Everybody used to be a .com company. Today, everybody has a website, but they don't think of themselves as a .com company. So I think AI is just another tool, certainly revolutionary and going to make a lot of things much more efficient. But I think companies that can figure out how to use it in a defensible way to solve a very specific problem, that's kind of what we're looking for.
That's it. So AI, we've talked about it throughout the day with various companies too, and the difference between an AI company versus a company that uses AI. And one of the strategies that a couple of entrepreneurs that are successful were telling the audience was that you don't use AI for the purposes of using it because as a practical application, but if it speeds up the business enterprise, whatever that may look like, it makes things happen faster in a safe, secure way, that's an incentive maybe for a way to get funding. I don't know if I agree or disagree with it, but where I want to go with this, if you think about the future, and it's hard to look into the crystal ball, you talk about this quarter and the challenges. If we look at the state of the world and what's happening right now and what may happen over the next 1 and 2 years, where do you see the funding world going? And is the gap going to widen or get closer for entrepreneurs being able to secure those resources?
I think ultimately there's always, everything balances out. So I think we're going to start seeing, more funds, more funding available, new funds emerging. We are seeing right now a contraction of number of venture funds. So, I'm getting various emails every few weeks saying, oh, we're not raising a new fund or this fund's going away. But I do think the number of venture funds doubled over the last, 5-6 years, a lot of new funds. And now it's sort of the cleanup time. So a lot of those funds who didn't produce good returns aren't going to be able to raise their next fund. They're going to go away. And I think that creates sort of, over time, more funding as those funds disappear, new funds come in. But I also think we have too many venture-backed startups. So, I was reading an article recently that was talking about how the number of venture-backed startups is the highest it's ever been. And there may not just be enough entrepreneurial talent for all those startups. So by having less startups, each company can have more talent. Right? So if you imagine if there's 1,000 founders and 1,000 companies, that's one founder per company. But we really need 2 or 3 per company. Single founder companies are really difficult for the founder. And we generally like to invest in teams, not single people. And that's why I think some of this contraction will be good and create better companies, better teams, bigger teams. And they will attract the capital. So I think ultimately it's a cycle. I think we're now sort of at that trough.
Yep.
And I think it's going to grow from here. And 10 years from now, we may be sitting in a bubble and we're all going to say valuations are crazy and then eventually it'll burst and then we'll be back to the trough. So
But you're optimistic, which I like, right? I love that. I know we can't look towards tomorrow, but I like the optimism. And I think that was really great feedback.
Yeah, and Mark, what I like about you, of course, is that you are the real deal. You tell it like it is, and it's wonderful to have you and Los Olas Venture Capital sort of as an anchor, based in Broward County. But you mentioned about even you're going throughout the state. You're also looking at deal flow outside the state as well. I think it's important as you pass some nuggets here to our viewership, startups, that you shared about, like, really take a look at what the venture capitalist thesis is before you submit and how important that is to get through, because startups are trying to break through. They're trying to penetrate. Hey, here I am. So a piece of advice, I think, is, as you mentioned, is look at our organization, our criteria. Yeah, we might take something that might be pre-revenue, but don't waste your time. Don't waste our time. Really look at that criteria. And you and I talked before about even looking at who the individuals are and then writing a personal communication, which is an art that's almost lost.
Mm-hmm.
Write a personal communication and say, hey, this is the type of company that I'm doing. I think I fit your criteria, and then can you circle back with me and give me any feedback, right? So Any other parts of thoughts of things that you want to share as sort of advice to the startups that may be wanting to reach out to you?
Yes, I think the customized approach is really important. I think doing the research, and rather than sending out thousands of emails, what's much more effective is trying to create a target list on investors that actually invest in your industry, in your type of company. Maybe pick 100 investors for the first, go, and then really send customized emails to each one of them after researching them, telling them why you're actually a good fit for their fund. If you think you really are, based on their criteria, based on their other portfolio companies. And that may seem like a daunting amount of work, but if you think about 100 companies, if you can do 10 a day, that's only 10 work days, so that's 2 weeks. If you do 10 a day, you can squeeze that in. And you actually don't want to send out 100 in one day, because you want to send out the first 10 and see what happens. Do people respond? What response do you get? Back when I was fundraising in 2001, I think, we did the same approach with FedEx envelopes.
Crazy. FedEx. Who would have thought that? Sending out the FedEx envelopes.
Yeah, they were printed letters, not handwritten, so we didn't have printers already. But it's almost 25 years ago, but we got a 50% response rate because they were very customized. They had a cover letter from one of our business school professors. And so, there's still that approach in email. I think it's very clear when I get an email, I can see if it's a generic sort of form email or something written by ChatGPT
or something, right?
Or if it's, written and says, we think we're a good fit for you because we meet your 5 criteria and here's why. And we're similar to your portfolio company XYZ. And that's why, we'd love to, and here's our deck. So don't ask for permission to send the deck. Just send it. If I don't want to open it, I won't. But at least it's there.
And so, given that piece of advice, entrepreneurs watching the podcast, how do they reach Olas Venture Capital?
Sure. So
if they meet their criteria.
Yeah. So we have our email address right on the website. And, just send us an email, look at our website first, and just reach out. But even better, have connect us warm through an intro. So maybe somebody that's already invested in your company, maybe one of your advisors, one of your mentors. We do prioritize inbound. We look at all emails, but we prioritize ones that come through trusted, known sources, because we assume that those are pre-vetted. And so that helps us. So that's really the advice there.
Terrific. Mark Volchek, Olas Venture Capital. Thank you, my friend, for being on the podcast. Appreciate it.
Thank you. Thanks for having me.
And just to finalize this, given the advice, you're going to get a whole bunch of FedEx envelopes at your office next week.
That's what I would do.
FedEx is outdated by now, but
that's
customized emails are fine.
All right.
Thanks so much.
Thank you.
Remember to subscribe, like, and share the Sunshine Startups Live podcast and follow us on social media. If you're interested in sponsoring or appearing on the show, please email us at booking@sunshinestartups.live.